Good evening and welcome to the Finance Committee meeting of June 27th, 2024. At this time, I will call our meeting to order, and we will start with the land acknowledgement. Grimsby is situated on treaty land. This land is steeped in the rich history of the First Nations, such as the Hattaway-Wendourong, the Haudenosaunee, and the Anishinaabe, including the Mississaugas of the Credit First Nation. There are many First Nations, Métis, and Inuit people from across Turtle Island that live and work in Niagara today. The regional municipality of Niagara and the town of Grimsby stand with all Indigenous people, past and present, in promoting the wise stewardship of the lands on which we live. Item number 3 on our agenda is to ask if anyone has any disclosures of pecuniary or non-pecuniary interest. And if so, if you'd be so kind as to raise your hand. I see none, so we will move on to number 4, which is the approval of our agenda. Does anyone wish to make any adjustments to the agenda at this time? Lay member Scandinavo?
Yeah, I'd like to add an item at the end in regards to the bylaw of the timing of the agenda issuance, if that's okay.
Yes, we could add that under other business. I guess we'll just call it the timing of the release of the agenda. Any other changes?
Are you asking for separations or changes or additions?
They're probably... Usually we wait until we get closer to that item,
Okay.
But certainly if there's something you want to lift, I assume that's in the, on the list of consent items.
Yeah.
Happy to note that now because that will...
Give staff a heads up.
Yeah.
7.1. Thanks.
I do, anyone wish to lift 7.2? Councillor Howe. So I will say that our consent portion of the agenda has turned into the regular agenda. That is so noted. So with those amendments to our agenda, and then can I have a mover and seconder to approve that? Someone to move it, please. Councillor Howe has moved it, a seconder. That would be Lay Member Hutchings. All those in favor of the agenda as amended? Thank you for that show of hands. That is passed. Then we will move on to item number 5, which is the receipt of previous minutes. So we have 2 before us tonight. The first one is the minutes of the Finance Committee of May 23rd, 2024. Does anyone have any amendments or adjustments that need to be made to those minutes? And then we have the Grimsby Economic Development Advisory Committee minutes of June 6, 2024. I will say, anybody have any questions on either of those? I'm going to step forward then and say that I do have some questions on the GDAC minutes. I realize we don't really have anybody here from GDAC, but my questions are more related to budget process and so on. So Tony, I hate to do this to you, but if I could put you on the spot and ask you a few questions related to that. And so my specific questions have to do with the fact that that committee, I believe, so in their minutes item 8.1, they talk about business succession planning and an application for a grant which was due June 23rd, 2024. But the part I was confused about is the next part that follows after that. It says that under budget, they're requesting $177,000 through the application. And it's this part: the town will be providing a $179,000 through funding and various in-kind services. And so my question is, I don't think that has been approved in any budget documents by council. And so when they apply for the grant and there's a matching component, what if they get accepted and council says no?
So yes, a good question. That town contribution is actually all in kind, so it's staff, mainly staff time that would be contributed as our 50% contribution to the grant.
Okay, that certainly helps clarify that, yes, yes. Because under the part where they said they're potentially looking to hire 2 individuals, I guess the $177,000 grant would be the funding for those 2 individuals then. And the in-kind would be staff time, our computers, our desks, that sort of thing. Is that right?
That is correct, yeah.
Thank you. Does anyone, yes,
Just, Madam
Member
Chair.
Hutchings?
9.10 really bothers me, the minutes. When it says that they're working from realtors from Toronto who represent an Indian hotelier, what does the person's nationality have to do with, I find that offensive. If I'm a Newfoundlander, would it say Newfie hotelier? So I just don't know why that's in there. I don't think it's appropriate for the minutes, and I ask to be struck from the minutes. Hotelier is fine, but the person's nationality doesn't seem to be relevant to the minutes.
Thank you, that is a good point. Would it make a difference if we were talking Canadian versus foreign investment, though? Would that? Perhaps we could just send the request back to our clerk's department and ask them to consider amending those minutes for that wording, either taking out the nationality, or if it is a foreign investment coming in, to even say a foreign investor or something like that.
I'd be happy with that, Madam Chair. And the other question I have in the same line is, what is the Legend property? Anybody know what that is?
No,
I've lived here
I do not.
lived here my whole life, and I'm not sure what the Legend, to buy something Legend, and this might fall under Section 238 of the Municipal Act, being a confidential matter if you're talking about somebody buying a piece of property in the town.
Perhaps we could just, in general, send all those questions back to our clerk's department and maybe back to our economic development officer, just to clarify that. So in terms of process, and I will defer to our clerk here, but if we have changes to their minutes that we're suggesting, typically, after we discuss these, we would then receive their minutes. We're technically not approving them, we're just receiving them, but do we reword this to say that we're receiving them with the suggested changes? Okay. Any other questions about those minutes then? Or suggestions? Then if I could have a mover and seconder to receive these minutes as amended, that would be Councillor Howe, and lay member Thompson has seconded that. With the show of hands, all those in favor of approving these, of receiving them, pardon me. Thank you, that is carried. At this point in time, we are now on item 6, which is a presentation this evening from Mr. Nick Poulias of CIBC Wood Gundy, and they are our new investment advisors. So if we could ask Mr. Poulias to come to the podium, and we'll let him take us through his presentations. Would you like questions at the end, or if we have questions during it, would you like us to put up our hand?
Questions during would be fine.
Okay.
Yeah, whatever's easiest for the group. That's perfect.
Okay, thank you. Then we'll start just with a mover and seconder at the end to receive the presentation. Sorry, so we won't just start. We'll do that at the end, and the floor is now yours.
That's excellent. Well, thank you for having me this evening. And obviously, thank you to Treasurer Delmonico for inviting me out to have this conversation with you folks. Really looking forward to it. So in terms of just moving forward, in terms of a quick agenda for tonight, what I thought we could look at would be just a really quick overview of our team. at CIBC Wood Gundy and how we go ahead and add value to our over 85 municipal relationships that we're currently working with right now. And then get into the market. And what I mean by the market, I mean, obviously, the economy and the market at a higher level in terms of kind of where we've been, where we think we currently are, and where we think that we're heading in the near future. And then kind of walking you through some initial conversations that we've been having with the staff here at the town around investment strategy, and then obviously how to then ensure that we can navigate the current economy and where we think we're headed, and ensure that the town's investment portfolio is well positioned to brace whatever challenges may be coming around the corner. So with that, you can change the slide. Yeah. Excellent. Couple more. Perfect. So our team at CIBC Wood Gundy, we're one of the largest and most experienced teams across the country when it comes to customized investment management in the public sector space across Canada. So the team has been around for over 40 years now and been working with municipalities across the country for that amount of time. Currently working with over 85 municipal relationships across Ontario and parts of Western Canada, and currently oversee about $3.5 billion in public sector assets. And so, I guess the one main way that we're able to add value and work with our municipal relationships is through the cost-efficient execution we can offer our clients, and that really stems from a couple things. First and foremost, the open architecture that we offer our clients. So work for CIBC Wood Gundy. Obviously proud to be working for CIBC, but we're not necessarily bank loyal in a sense that we do have the ability to go ahead and competitively shop investment products across all of the large Big Six institutions across Canada to ensure that the municipality is receiving the best rate possible, regardless if it's with CIBC or not. And then the economies of scale that we can offer our clients by overseeing $3.5 billion in assets and working with over 85 other like-minded names. And so, obviously with that comes the ability to kind of effectively, shop large amounts of assets and make sure that the banks are all competitively pricing the investments that we're looking for just based on the size and scale of our operation. And last but not least, again, it's the full service retail investment arm of CIBC. So we're obviously backed then by those collective resources that CIBC can offer, and we often are able to bring those resources out to benefit our municipal relationships if needed, whether it be members of our capital markets team or members of our economics team as well. So moving forward. Just really quickly, the team. So it's myself and two other senior investment advisors, and it's a full team that's backing our operation as well. We really pride ourselves on the customer service and the customized reporting component of our business. We know that for a lot of municipalities, that's often a struggle, is the administrative burden that comes with overseeing the investment portfolio. So it's a team fully built out around working with public sector names across the country. And so, again, that's one of the main things that I'd like to highlight today. And so moving forward, and really to kind of get into the meat of today's presentation, is really to kind of provide a quick update on where we are, where we've been really quickly, and then ultimately where we think that we're headed over the next 12 to 18 months. And so, I think the story across Canada and really across, the developed or the developing world nationally has been obviously interest rates and inflation kind of coming out of that, post-COVID world. So what we're looking at here in that red line would illustrate kind of the year-over-year increase or change in inflation, with the yellow line looking at that overnight target rate from the Bank of Canada. The Bank of Canada obviously has a mandate to ensure that inflation sits at around 2%. And one of the tools that they use to ensure that happens is by administering that overnight target rate. And so, going back to the far left-hand side of the graph, and what we're looking at there is kind of where we were just pre-pandemic. And so, heading into the pandemic, you had inflation sitting at around 2%. That overnight target rate, which is a very key, lending rate, it obviously will impact prime, other short-term lending rates, both fixed and variable as well, was sitting kind of in around 1 3/4. And then within a short period of time, obviously the pandemic had came and went early on, and what we saw was a decrease in inflation initially, and also a corresponding move lower in interest rates. And then we sat there what felt like forever, and you can see that yellow line was basically on hold with interest rates, that overnight target rate at 0.25% for the better part of almost a couple of years. And then what was kind of slowly happening in the background was we started seeing inflation moving higher, right? And initially the commentary from central bank policy around both Canada and across the developed world was that they viewed it as being kind of temporary, or it was transitory, right? This wasn't going to last. This was going to be kind of a short little blip, and we were going to get out of it, and then we're going to resume back to normalcy, right? And then kind of the main catalyst for what really kind of pushed things materially higher was, the crisis and the conflict that originated overseas in Russia and Ukraine, and the corresponding increase to commodity pricing and the supply disruptions and the corresponding move higher in inflation that resulted. And then what we saw basically from March of 2022 through to not too long ago was a significant increase in rates. And you saw that overnight target rate go from 0.25% until it got up to 5%, basically, last summer. And then we sat there unchanged for the bulk of this last year until early this month, and we got a little bit of relief. And for the first time in a while, as we've seen that red line start to move lower and inflation kind of getting back to that 2% target, we saw the Bank of Canada actually step in and reduce that overnight policy rate by 0.25%, providing some initial accommodation. So moving forward, in terms of kind of what we've been looking at here, so like we said, inflation globally has eased significantly. Sorry, yes, go ahead.
We have a question here.
Yeah.
Would you use your mic, please?
First, I'll preface this with, I'm not an accountant. I'm one of the few here that isn't. So you talk about this blip with the Russia-Ukraine conflict.
Yeah.
And you're saying it's related to commodities. So is that because we were buying a lot of things from Ukraine or Russia, importing? Because I sit and think that, well, the other major conflict is the sort of Palestine-Israeli thing, but I don't think we're doing a lot of imports from either of those places. So I just wonder if it's this sort of political instability that causes this, or is it because we were actually getting something and that supply's been cut off?
There's definitely that. I think it's almost kind of a perfect storm, right, in terms of kind of where the sanctions that were put on that portion of the world, Ukraine and other parts of Eastern Europe being, major hubs for wheat and other kind of, commodities that would filter through to, obviously food pricing, and obviously, thinking about natural gas and oil and other kind of supply disruptions on that side as well, too, right? And I think really what it may have been as well was just kind of this perfect storm, right? We hadn't fully come out of COVID just yet. There was still some existing supply chain disruptions that had happened, and then that was kind of an additional layer of supply chain disruption that was obviously going to be unique to certain sectors of that basket of commodities, whether it be food related or oil and gas related as well.
Okay.
Right? Yeah.
Thank you.
Yeah, no, for sure. That's a great question. So I think, the main story here is that, it's been a while now since inflation peaked, which was in around 8-9% kind of globally, kind of a couple of years ago when we started increasing rates. And what we have seen is that gradual decrease now over the last couple of years, right? Basically having seen the fruits of the labor of those increase in rates, actually playing it throughout the economy and bringing things back down to more normalized levels. So moving forward. And I think the one thing to kind of really consider here locally was, when you started looking at the components of the inflation print in Canada, and when you start looking at where we were trending without the impact of shelter-related costs, the reality is that there's been, for a couple months now, we've actually seen inflation ex-shelter in Canada actually trending in around below target. And so this brings up this concept that's often being, communicated, whether it be in the news or on TV or whatnot, about policy-induced inflation, right? The fact that here's the bank increasing rates, and what's been really increasing has been, obviously the cost of rent, cost of mortgage, interest costs, et cetera. That's in that basket of goods. And so stripping out the impact of, the policy-induced component and stripping out the impact of shelter, you can see that the rest of that basket of goods has actually been trending lower for quite some time now. So. But I think the reality is, and we saw it earlier this week, is that there still is some volatility, some near-term volatility that needs to be kind of shaken out. We know that directionally things have been moving lower, but we had a print come out from the Bank of Canada, from Stats Canada earlier this week that suggested that in the month of May we actually saw a slight reacceleration. Right, so it's not going to be just a straight move lower. There may be some bumps along the way, but directionally, our view is that we are kind of getting back closer to that 2% target. Right. And so, as much as they're focusing a lot of their efforts on combating inflation, the bank's obviously looking at other key economic drivers as well. And one thing that we've been keeping an eye on, both at CIBC and just a lot of our other big five peers as well, has been the strength of the Canadian economy in terms of GDP growth, right? So how quickly is the economy growing in real terms? And the reality is, when we start looking at this data in per capita terms, which is really important to consider, given the amount of new Canadians that have come into the country over the last couple of years, and what that's been contributing in terms of consumption, in terms of that top line year-over-year improvement. In per capita terms, using 2019 as a base year and looking at where we've been over the last couple of years now, the reality is when we compare ourselves to our other developing nations across the world, the US, the UK, and the EU, we're dead last in per capita terms. So if you use 2019 as a base year, and here we are in current present day, the Canadian economy is actually contracted by almost 3% in per capita terms, versus the U.S. economy, which is that top line there, that's actually almost seen about a 7% increase in real increase in GDP per capita, which is significant, right? It's not all policy induced. There's other things as well, too, that have obviously been driving that wedge. But nevertheless, it's safe to say that the Canadian economy, aside from inflation, hasn't been performing very well over the last little bit. And so what we're looking at as well, we talked about GDP. On the employment side, a very similar trend. So Canadian unemployment rising more than other regions. That blue bar looking at where we were trending kind of in that post-pandemic low when things were extremely tight. It was extremely hard to find people to come to work and fill those vacant spots, to where we've been over the last 3 months now. And you can see that there's been a sharp increase in Canada, right? And that's obviously something, again, that the Bank of Canada is keeping a close watch on as well. Moving forward. And then I think when you open the hood and you take a deeper look and you see, that breakdown between public, private, and self-employed employment, the reality is that the private side's been basically stagnant now for almost a year, right? And so the significant increase that we've seen in terms of employment has actually been driven out of the public side, which fundamentally makes a lot of sense, right? You're going to bring in multiple million new Canadians in the country. You need to have the public infrastructure in place to support those new Canadians. But I think we can all kind of generally agree that, you want to see the private side also increasing as well, right? The sign of a healthy economy is not just public sector employment increasing. You want to see the private side carrying their weight as well, too. So, moving forward. So, I think what we're starting to realize now is, there's always been talks, and I think everyone in the room has heard this, been tossed around by many experts out there, is that, how interest rate sensitive the Canadian economy is, whether it be household debt levels and whatnot. The reality is that the bank's ability to increase rates was going to have a significant impact on the economy in Canada, a lot more so than our peers in the South, right? And a lot of that stems from just the way our mortgage markets are structured, right? In the U.S., you can go out and buy a 30-year fixed mortgage. Now, it's not portable, so you can't move. But if you're someone that bought a house pre-pandemic and you locked in a 30-year fix at a really attractive rate, the fact that they're increasing rates doesn't do anything for you. All it's done now is pay you higher costs on your cash in your bank account, but you're not seeing the same potential pressures from a variable rate mortgage or for someone that had a fixed rate that's scheduled for renewal that is also, potentially having to face a significant increase. So what are we seeing? Well, we're starting to see some cracks, right? And I think this is what everyone's going to keep an eye on. And you knew this was going to happen, right? That you leave rates at an elevated level for quite a period of time, eventually you're going to start seeing some weakness in the economy. So we're seeing increase in business bankruptcies in Canada, increasing from where they were in 2020 to where we are currently. So, moving forward. And we're also seeing signs of, consumer loan categories and some initial signs of distress in terms of, 90-day delinquent consumer loans being slightly higher than where they were, again, before the pandemic, where we were before we started increasing rates, and then obviously where we are currently right now. So again, it's a trend that I think everyone was kind of keeping an eye on. And effectively, the central bank you're playing this game of chicken to a certain extent, right? How long can I keep rates elevated to put pressure on inflation without ultimately breaking the economy and ensuring that we don't have this, being elevated for too long and having lasting impacts on the economy. So moving forward. Again, household debt levels in Canada rising, highest we've seen things in over a couple of decades. A lot of that being driven by increase in housing-related costs, right? And so, again, something to keep an eye. And the reason why, moving forward, is the fact that the full hit from those higher debt servicing costs in terms of mortgage renewals hasn't even been fully seen yet, right? And so, the Royal Bank put out a really interesting print here that basically says there's over $400 billion in residential mortgages in Canada scheduled for renewal just in next year alone, right? And so, again, this is part of that thesis that's driving the fact that, not just our team at CIBC, but a lot of other big five bank peers as well, expecting rates to continue to move lower here to try and get ahead of those renewals. Because otherwise, you're going to have individuals locking in rates, again, significantly higher than where they were pre-pandemic. Someone who has a 2025 maturity, that means that they would have probably locked things in almost at the basement there in 2020, right? So that's going to be a significant significant impact or improvement or increase to those debt servicing costs. So then moving forward here, I guess just to kind of set the table. So we kind of have an idea where we are, right? So we've been elevated now for quite some time. We're seeing inflation trending lower. There's other signs of weakness in the economy. The in-house view at CIBC is that we're going to continue to see cuts from the Bank of Canada, reducing the overnight target rate, and it's going to be pretty significant. So we're looking at right now 4 3/4 on the overnight target rate, which again feeds directly into prime, which is going to feed directly into short-term lending rates, seeing that move lower by 200 basis points between now and basically December of 2025. Sorry, go ahead.
Do we just have a typing mistake here? There's a column called 2024 December, and then 2024 March, and then 2025. Is that really 2025?
That should be March 2025.
Okay,
I
thanks.
apologize for that. Thank you for the catch. We're not going back to the future here. Doc Brown's not coming with a DeLorean to take us back. But no, thank you for that. Yes, so lo and behold, it's lower, and I think what we're expecting to see is, we've seen other developed worlds, other countries, cutting rates. The Eurozone, Sweden, Switzerland also moving rates lower. The view is that the U.S. is going to be a little bit behind us in terms of cutting rates, and that's obviously then going to have an impact on the currency as well. We're seeing it already with the Canadian dollar weakening against the U.S. We're going to probably see that weaken a little bit more but until things kind of top out and then gradually start moving back to a more normalized range once the U.S. catches up. The reality is that they're just running a lot hotter than we are, and so they have the ability to kind of stay on hold for just a little bit longer. So moving forward. In terms of the economy at a high level, again, relatively hard to see, but I'm glad you have hard copies in front of you. Basically, the story here is you're going to probably see a couple quarters of, flat to almost negative growth in terms of GDP. But what we're hoping for is that you are also going to see CPI get back down towards that 2% target. But again, that may also have a corresponding uptick in unemployment. Again, the bank's going to kind of wait and play this out fairly cautiously, and that may result in a little bit of pain in terms of growth and unemployment being slightly higher than where they are currently right now, but it's all geared towards hopefully bringing things back to more normalized levels in terms of inflation. So, perfect. So moving forward. So from our perspective, in terms of working with the town and having conversations, in terms of how we would go about the investment process, it's going to obviously begin and end with the legislation that you're enabled to, obviously that governs the process in terms of investments, which is the Muni Act and Section 438(97) in terms of what would be an eligible investment to consider, right? And from there, it's building out a policy, taking into consideration the market environment, which from this point, it looks like things are moving lower in the near future. And then from there, it's working with the finance staff to propose some recommendations to ensure that, we're doing the best we can to ensure that those dollars are earning the best returns possible within the constraints of both the investment policy and the legislation. So moving forward. So again, key factors here, just to kind of quickly skim over this here, but I think really the most important thing, and other than it being a mandate as per the Muni Act, it's having a policy in place that is obviously going to be there to safeguard those municipal funds and ensure that there's some discipline added to the process to hopefully improve returns over time. So moving forward. So in terms of investment policy, we had a chance to sit down with Treasurer Delmonico and his staffing. And what I'll say right off the bat is, we do this for a lot of our clients. It's a really good policy. It's very, well written, very well constructed. If anything, we talk all the time about risk tolerance being, your ability to take risk, being what does the Muni Act allow you to do, and ultimately what does the town decide to consider. And so, I think if anything, you're slightly more conservative than what you're able to do. One thing that came from the 2018 amendment to the Muni Act was a reduction in that minimum credit rating. But the town kept things at AA low, which I think is prudent. I think it makes a ton of sense, right? Late in the business cycle, and you want to have higher quality investments in the portfolio, and that's what they have. There's a couple of things that we would take away, and we can have a conversation, obviously, with the finance staffing offline on this, but other pieces of feedback would be, putting some language around a workout plan. Again, that's one of the modernization, or one of the updates that came to the Muni Act in 18 was basically the ability to put a plan in place so that if something was to happen and an investment was downgraded, rather than having to effectively sell the security within a predetermined time frame, it's actually putting a plan in place to ensure that you can get out of that position with the least amount of damage or loss incurred on behalf of the town, right? So it's putting that language in place. And last but not least, it's working with them to obviously to put some portfolio term limitations in place around the percentage that we will have invested in each tenor to ensure that we're always well capitalized in both the short and long end of the investment portfolio. So moving forward. So in terms of the historical snapshot, in terms of what the town has managed to achieve over the last couple of years here, so what we're looking at here is a historical investment performance from 2019 through to 2023. And so what you can see, and again, it's not entirely surprising given where we were from an interest rate landscape, right? So for most of 2019, 20, 21, and 22, interest rates were basically at in around 0%, right? Slightly higher than that, right? We mentioned that the overnight target rate was at 1 3/4. So the reality is, at that point, you're doing the best you can in making whatever you can up and above that cash rate. And the portfolio largely consisted of cash and short-term GICs to kind of enhance those returns. But I think the one thing that came from the pandemic, and one thing that I really want to go ahead and applaud the staff for, was by keeping things short dated and keeping things variable tied to prime in your cash account, you managed to ride that wave higher here as rates increased significantly in 2022 and 23. And what it's done now is it's left the town in a really enviable position in the sense that you have, over almost $50 million in fully liquid cash that can now be deployed at what may very well be peak interest rate levels, right? Versus other municipalities that we started working with after, the last couple of years, where they had committed the bulk of that capital when rates were at next to zero. And so those levels are now all tied in, and they don't have the ability to go ahead and put money to work. So I think it's a great and a very enviable position for the town to be in, right? In that sense. Moving forward. From an investment income standpoint, in terms of actual dollars earned, you could see that for the while there, you were generating in around $1 million to $1.5 million, and then last year was a really great year, largely off the back of the positioning, the staffing, by having things short dated, tied to prime, riding that wave higher in terms of overnight target rate, and then complementing that rate with short-term attractive GICs. But I think the reality is that there's a little bit of a pivot here, and given where we envision the market to be in the near future now, it's having a deeper conversation about terming out and actually now locking in these rates of return for an extended period of time, given that they may not be around over the next couple of years. So moving forward. So in terms of the strategy and the conversation that we've been having with the staff now over the last couple months, it's been really the main risk that we've been trying to kind of mitigate or make sure that we can try and kind of conceptualize is reinvestment rate risk, which is essentially, trying to understand the current market environment, given where we think that we're moving in terms of rates moving lower. It's what happens to the town's investment portfolio if and when short rates continue to move lower, right? And trying to get ahead of that, start locking in returns to try and basically provide the town with some predictability in terms of what that investment portfolio is going to be generating over the next little bit, right? Especially around budget season, talking about increases or decreases, increase to the levy. It's important to have a solid idea of what that investment portfolio is going to generate, and actually having some fixed rates of interest attached to it to give you a better, clear indication of what your portfolio is going to generate for you. Also, having conversation about diversifying credit, right? You're late in the business cycle. Previously, the bulk of the investors were sitting with just a couple of the big six institutions. When we came in, the first thing we did was let's have conversations about diversifying. We're not worried about any of the big five or the big six and their ability to repay these debts back, but it's prudent to go ahead and diversify as best as possible across all of those names, and even going out there and starting to add non-bank credit to the portfolio, right? Upper tier municipalities, provinces across the country to ensure that the portfolio is well diversified. And last but not least, it's been actually going out and actually extending duration, right? The bulk of the investments we had, which again was really well positioned on the way up, which was short dated, it's now having the conversation about, again, increasing the term to maturity on those investments, locking in those rates for longer, but doing so via the form of securities which are fully liquid with active secondary markets so that we have the ability to go ahead and sell them ahead of time if need be. And also one thing that we've been looking at as well too, and having deeper conversations, is around diversifying the investment portfolio out of just vanilla, traditional fixed income or bonds or GICs, and actually even looking at potentially adding a sleeve to the One Equity Canadian equity mandate, which is, for those I'm sure familiar with One Investment, it's basically an investment platform backed by LAS and Chums, and they have a equity mandate that's actively managed by an investment manager that's performed really well over the last little bit. So for longer dated monies, that's something that a lot of our municipal accounts will often consider for longer dated funds with kind of a time horizon longer than 5 years. Moving forward. Yeah, so in terms of kind of what we kind of envisioned, how we were kind of, again, this is, kind of an illustrative example of where we envision things moving is, again, it's diversifying things. You see what the town is currently earning on cash on deposit, which is roughly 5.2%. Basically, the Bank of Canada, the TD prime rate, less a spread of 1 3/4. It's trying to understand that, yes, that's where we are currently right now, but if we see the Bank of Canada cut by 200 basis points, that rate of interest could actually come down to closer to 3%, right? So it's having conversations now about going out and adding some longer dated, duration to the portfolio. Now, when I mean longer dated duration, I mean, 3 to 7 years, right? Going out just a little bit longer to lock in those rates of return at levels in the 4.5% to 6% range, right? And again, it's been adding some other issuers as well to try and diversify the credit in the portfolio. So we can move forward as well here too. That gives you a rough idea right now of kind of how we were going to position things in terms of duration and what we're kind of targeting in terms of ensuring that things are, yeah, go ahead. Any questions?
We have a question, yes.
Yeah. Sorry. Thank you. Through you, Chair. And the only reason I'm asking is being retired, I was with my financial advisor last night.
Yeah.
And you see you're getting 5.2%, and I always say to him, well, you're also getting 2.5%, so am I really getting 2.5%? So is this 5.2 the town's actually getting, or is there fees? And I'm just...
No, that's a great question. So I can't, I'm not going to speak to that. I can speak to it in general terms. That actually is a banking arrangement that the town has through TD Bank, through their banker. So that's effectively what they would pay in terms of monthly rate of interest on deposit. There may be other, related fees that the institution charges as well. I would kind of lean on the staffing to comment on that, but yeah, exactly. Any other questions?
I'm not sure that was exactly the question. I interpreted the question to be that we're talking about rates of return.
Yeah.
But there are also investment management fees that we're going to be paying. And just to clarify, these rates of return do not reflect the investment fees that we are paying as a town.
Are you referring to the historical records that we were talking about, like the 2.5% that was from the last 5 years or so?
And maybe to clarify, I mean, these are, the charts you've been bringing up are where we are on June 27th.
Yeah, that's right.
And what you are contemplating doing, right?
That's right.
In terms of investments by maturity dates and things like that. But any of these rates do not reflect your fees, like just to be clear, right?
No, they would. So the way that we get compensated as an investment dealer is we typically, the majority of our municipal relationships will use a transactional fee model where they'll pay us 10 basis points on the initial purchase of the investment. So if there was a bond or a GIC that was yielding 5.1%, we would then turn around and sell that to the town at 5%. So it's not an out-of-pocket fee per se. It's just we remove it from the economics of the position. Let's say it's a 5-year GIC. You'd pay us 10 basis points on the initial purchase, and then there wouldn't be any other commissions or fees charged over the life of that purchase.
Does that answer your question?
Does that make sense? Yeah. So, yeah, no, I apologize for that. No, you had mentioned 5.2, so that's why I was trying to make sure I didn't, overspeak there in terms of the cash account. But yeah, so whenever we show an investment to the town, it will be net of our fee, and there's no ongoing fees for anything else we do to provide service to the institution. So does that answer any other questions? Yeah? That's perfect? Okay, excellent.
I think there was a question here from Member Hutchings.
Yeah.
So do we ever consider buying, so I'm assuming our debt is issued by the Region of Niagara, right?
Yeah.
So do we ever consider buying Region of Niagara debt and buying our own debt back?
100%. We would obviously consider that.
Because we don't have anything here.
You don't own it currently. So I'll be honest with you, there was a decision between the Region of Durham and the Region of Niagara, and the reality was the Region of Durham was a higher rated credit and actually had a higher rate of return. So it's a AAA rated credit versus a AA high. And the yield on a similar rated bond was just, it fit what we were looking to achieve in terms of what part of the yield curve we were looking to purchase an investment. But you're right, we would obviously look at purchasing the region of Niagara bonds if they were outstanding and they made sense within the context of the investment portfolio. Does that answer that question?
About 95%.
Okay.
Why wouldn't we try to invest in our own region that we're issuing the bond from, show confidence in that as well? I know you're trying to maximize returns, but the difference, the delta is not very much.
It's not much. It's about 5 or 10 basis points, right? And I think the reason why that we kind of reach for that region of Durham bond versus the Niagara bond that we were looking for was a little bit shorter dated. And I just thought it made more sense if we were going to add a little bit of duration to the portfolio through a high quality AAA name. We identified that region of Durham bond as just basically looking cheap in the context of the economics of it, right? But trust me, more often than not, I know a lot of our lower tier peers would rather buy their own upper tier than buy other upper tiers. So whenever that opportunity presents itself, they win the tie, or let's say it, if it's close in terms of the economics, we'll often side with the local. Or the upper tier.
Tie goes to the runner.
Tie goes to the runner, exactly,
In this case, it's
right?
the region, yeah.
I'm a baseball family. I get that reference. I know exactly. So, yeah, no, you're right. And you can be, I can almost effectively, guarantee that we will be looking to add the region of Niagara if they come out with attractive terms that make sense for the portfolio. So, any other questions? So you can move forward here. I think ultimately, I think that we've done kind of the bulk of what we wanted to accomplish today, which is kind of give you an idea of what we've been doing to try and help the town basically go from a really advantageous position to ultimately trying to ensure that we can be in an advantageous position for many years to come and give the finance staffing the predictability of those returns for not just the next year or two as rates continue to stay slightly elevated, but for the next 5 to 7 years out. So, any questions? Go ahead.
Yes, Councillor Howe.
Thank you. Through you, Chair. Earlier on, and I believe it was page 18, I think.
Yeah.
I just made a note. You used the term normalized. Does that term, has it been redefined, or do we have to redefine? And I'm talking globally, or, in the macro. Normalized. Are we going to see a normalized before? And what was normalized? That's
So
where,
normalize in terms of inflation? Is that
well, just overall, when we take a look at, when we're trying to predict, when we're trying to make our forecasts.
Sure.
Is there normal?
I think what you can say is there's definitely a lot more of that tail risk that exists now in terms of these abnormal events having maybe a greater than likely event of actually happening. For us, when we talk about normalize, it's getting back down to that Bank of Canada target and getting back down to kind of more recent term historical norms in terms of, GDP, kind of those key macro drivers, inflation, unemployment, et cetera, right? So when we're talking about normalizing inflation, it's more around getting it back from, 8% where we were a couple of years ago to getting it back within that, that 1 to 3% band that the bank has in mind in terms of their target, right? But, who knows? I think the one thing that we keep talking about is kind of the new world order in terms of, more protectionist measures and global geopolitical events, right? I think, no one has a crystal ball. We don't have a vacuum. From our perspective, when we're having these conversations, I side on the fact of we're trying to achieve predictability, diversification, and ensure that, because I think the one obvious risk that would exist right now is, having 75% of the investment portfolio fully liquid in cash tied to prime. That's probably a risk that you don't want to wear right now, given where we think that we're headed, right? And so I almost view it as an insurance policy per se, right? Because the number one question you get asked right now is, if we're earning 5.2% on fully liquid cash, why would we go out right now and buy investments with fixed rate of interest lower than that? And it's all predicated on the fact that, there's a very high likelihood of us being lower in terms of rates. And so if you wait till things actually lower to go out there and start buying those fixed rates, those rates are gone. So you kind of have to be early. You have to be willing to get in there and get in early, because if you wait for things to correct and wait for inflation to get back down to 2%, wait for the bank to get back down to 2 3/4, these attractive fixed rates that we're talking about for the town, they'll be significantly lower. And so from our perspective, it's, you still want to have cash on hand, you want to have cash on deposit for operating, and I still think it makes prudent to even be slightly overweight cash, because you are getting a really attractive rate, and who knows what may be coming around the corner. But I think for our perspective, it's all about predictability and trying to lock in these returns for as long as we can within the reasonable liquidity constraints of the town. So is that, again, kind of a roundabout answer there? And I know what you mean about normalize. I've been doing this job for over a decade now, and, you thought you knew what normalized looked like. COVID tested it. I think everyone's understanding what normal was, right? So I think we have a pretty good idea where we're headed, but it's directionally, it's not necessarily where we're going to be next month or even the next 6 months. It's more where we're going to be the next 24 months. That's what we're kind of targeting. So, yeah.
And yes, continue.
If I can just follow up. And you use that, and I think on the first page or the second page, you use the 12 to 18 month kind of a window that you're looking, then you just mentioned 24 months.
Yeah.
Where do you see us shrinking that window?
Well, I think it's going to be data dependent, right? I think, and that seems to be, when you see the market kind of repricing expectations on where they think things are headed, it's all predicated by how quickly we get there in terms of seeing data consistently coming in according to their own expectations. So like I said, this May print that just came out in terms of inflation, it's now had the investment community rethinking whether or not the bank's going to go ahead and cut rates again in July. Heading into that meeting, it was almost 65 to 70% likelihood they were going to go ahead and cut by another 25 basis points in July. But what's happened now is you had a print come in slightly hotter than consensus, and now we still have a couple other important prints coming up in June. You have another employment print number, and you also have June inflation coming out before the July 24th meeting. But what's happened now is if you see a couple months now of things being, again, hotter than what they would like to see, what that does, I think, in my opinion, is either it increases that long-term rate from maybe 2 3/4 to maybe above 3, or it pushes that window out, right? And so when I talk about 24 months, maybe it's going to take, another 6 months of elevated rates to get back down to that target, right? That's kind of what I'm referring to. It's more the timing of when we get there. So, my pleasure.
Any other questions from the committee members? Then I'm going to say I have one.
Go ahead. Yeah.
So early on in the presentation, you talked about deploying 50 million. And then near the end of the presentation, we have a number of charts that show our total investments of, in our general fund, 80 million, and in total 84 million. So do these charts reflect the fact you have already deployed at least 50 million into the strategy that you were talking about? Or are these just a snapshot of where we are today? And going forward, we're going to be implementing your changes, just to clarify that.
It's a great question. So currently right now, that TD Bank high interest account has a balance closer to 50 million. So we've already deployed, as a team working alongside the town, we've deployed 20 million over the last quarter. But there's been conversations about looking at putting to work another 30 million potentially. So what you're looking at here is potentially what this may look like if we proceed with investing that 30 million according to what we have in mind. So.
Okay, so for example, to use the chart on page 28 as an example, that's more I'll call it a pro forma of where you want to land.
That's an excellent reference. It's more of a pro forma of where we could be in the next couple months potentially. Yeah.
And just to be totally transparent, a question to Mr. Delmonico and our staff. I assume that you have done cash flow projections and things like that, and that you too have landed on the same place, that's how much extra of our investments need to be deployed on a more long-term basis.
Yes, that's correct. We've tried to utilize our cash flow projections as much as possible to try and match those maturities to our needs.
Thank you. Any other questions from the committee members then? I guess I have just one last question, and that may be more for Mr. Delmonico as well. You know, there were charts in here about bankruptcies and things like that, and one of the things we've talked about at our Finance Committee meetings before is that where our property taxes, our water receivables go and so on, can sometimes be the canary in the coal mine that tells us also, that is one of those indicators that tells us if people are struggling to pay their property taxes, their water bills and so on. Perhaps for our August meeting, we could just get an update on a continuity or a historical perspective on where they are. We're not trying to micromanage the collection of them or anything like that, just sort of take a look at them always to see if we're seeing trends, if we're seeing downturns, upturns. Just as you had the chart on bankruptcies, it's like, do we have any indicators in-house that would tell us where we're heading to, right?
Yeah, sure, we can take that back.
Then, Member Thompson.
Thank you. Through you, Chair. I think you hit on exactly what I was going to do later, ask the director about a strategy, because thinking of the taxpayers after Nick had mentioned about the consumer stress, does the town have a strategy prepared? So that's good to hear. I think the other one is also to the director, but also to council. Are you aware of our investment policy as councillors, and you're confident in it as a policy since you approved it? And I'm just curious on that portion. And secondly, our new director, this policy, does it meet your needs, or do you need to look at amendments, or have you, because if it's tying you back, you know, this is a perfect time. If we can help you out in any way, definitely will.
Yeah, through the chair, if I can start. Yeah, I think after having this discussion with Nick and the review of the policy, I think it's in good shape. It could maybe do with some tweaks, but I think maybe long-term, we might want to think about the option to move to what's known as a prudent investor standard that would allow us to diversify even further beyond Canadian bonds and equities into global. But doing that would require us establishing a joint investment board. That is something that we could latch on with the one fund to combine with them, but it is something that we'd have to consider carefully, because once you make that move, you can't go back to the way it was. So, thank you.
I mean, I'll just add something, and then I'll give the floor to Councillor Howe. But the binders that were circulated tonight were our finance policies, and they've been distributed to all our members in hard copy, and will be coming out an electronic version as well. And within the index, you'll see our investment policy, which was last updated in September of 22, which was before most of our time on this council or on this committee, for sure. So I would suggest that now that we all have hard copy of this, you know, might be some homework or some reading late at night for each of us too, just to reacquaint ourselves with that policy too. Councillor Howe, do you have a question? Or?
Probably more of a comment is our policy has changed very little in 30 years or 40 years. And for the most part, and sir, you commented on the shape that we're in. And it's because of those approaches and those thoughts and considerations, and that we can say that, or you can say that about us. So, you know, as long as nobody thinks that we've got to completely reinvent the wheel, and we're going to hear that because we're rolling around some numbers here today that, you know, a lot of people kind of go, oh boy, oh boy. In fact, it's not the case. We've just got to keep the town in a good state. So, you know, just that's what my biggest concern is, and you'll hear it. But anyways, thank you. Just.
Member Scandinavo.
Thanks. Just, again, more of a comment. I did quickly try to poke through the investment policy in the hard copy we just received, And I was wondering if there's a possibility to include also like our non-traditional investments in there, like in investments in, example, NPI and GPI, like those, again, they're not typical investments that we're doing with our investment advisor here, but they are definitely town assets, and we do hold shares of other corporations. So I wonder if we can broaden the scope of the investment policy to include things of that nature. If that's okay.
To our other members, do you have any thoughts on that? Do I see heads shaking? Yes? No? Yes, Member Vardy.
And again, I'll preface this with I'm not an accountant. So we own something, right? We own 90% of GPI, MPI, Niagara Power, MPI. Can we borrow against that at a higher interest rate?
Sorry, what's the asset?
It's a hydro company.
Oh, hydro company.
We own shares in a holding company which owns a local distribution hydro company.
So we don't traditionally look after the lending component of that relationship, but we have a really great relationship with a specific public sector not-for-profit banking arm through CIBC Commercial Banking. So I can take that question back to them, and I can share that color with Director Delmonico if you like, just to get a better idea of what the asset is and what those terms will look like at a high level, if you like to consider that.
Is it a good question to is it worth trying to do something like that or not? Sort of like borrowing against your mortgage and then getting in order to invest?
So the entity that primarily is borrowing is the actual LDC, Grimsby Power itself, which is our local distribution company. And they, of course, are quite bound by the rules from the Ontario Energy Board as well, right? So I can say there are a lot of limitations probably built into some of this that are outside of what we could control here at the Finance Committee or at our Finance Department. It's an interesting question, though, because if we can get a better rate for our operating company, why wouldn't we, right? I can only go based upon their last set of financial statements, which we're talking December 31st, 22. But at that time, they were into a line of credit. What are those rates? Could they do better? Would they be allowed to do better? What could we do? It's a very open-ended question that probably is worth thinking about for sure, right? To at least know where we could or couldn't go to help them. I think to go back to Member Scandinavo's question, though, his comment was really that our investment policy currently covers, I will say, third-party investments as opposed to our own investment in our own internal subsidiaries. And so I may be reading in and do correct me, but I'm gathering from your comment that you're thinking maybe we should also expand our investment policy to include the subsidiary companies that we own, that we need to incorporate that into our knowledge and our control of our risks at the same time. So I guess my question to our other committee members is, are you interested in doing something like that? Member Hutchings.
I would be very interested in that. I mean, we have an investment, what did you say was it, December 31st, 2022? On this, what was the number, the equity? Anyway, but I'm just wondering, it's in the millions and millions of dollars, and here we are talking about 0.1% off of something, and we're not talking about that. I would think that should be in our SIP, our Statement of Investment Policy, and we should be looking at what our return is off that investment as well for the taxpayers of the town of Grimsby.
Any other members like to comment? I see some nodding of heads. Councillor Howe.
Member, I think your point is well taken, and if it is there, we need to better understand it and the restrictions or the opportunities, I guess. Let's be optimistic and say the opportunities that maybe we should be aware of and we're not aware of. But I think we somehow roll it in. I think I'm quite supportive of that.
I will say from my remembrance of the town's balance sheet, I always say that our first and largest investment is the investment in tangible capital assets, which is in the hundreds of millions of dollars. The second largest asset on our balance sheet is this one that we've just talked about. And then the third largest one is our investment in Niagara Power / Grimsby Power. So I think what I'm hearing is general consensus from the rest of our committee members that we would like to expand the scope of the review to include the internal investment in our subsidiary companies. Just thinking out loud about how to do that, would you like a resolution perhaps, or would we like to ask for a report back from our finance director at an up-and-coming meeting to look into that? And I think it's really a two-sided question. It's a question just like today of looking at what our investments are earning, but it's also a question of looking at our investment policy and what's in the portfolio, right? So, Mr. Delmonico, please comment.
Yeah, I think I'm going to have to educate myself first and foremost on the arrangement and familiarize myself more with the Niagara Power arrangement, and then I guess we'll have to see what is legislatively available to us in that regard, and maybe that's the place to start.
But we certainly could authorize you to look into that, right? So, Member Scandinava?
Yeah, I think all I was trying to say is that, like, it's an investment, right? Like, our investment policy is talking about investments. We spent time talking about these investments, right? Just to say that, in my opinion, is also an investment. It's just, not the traditional investments we spent time talking about. It's an investment in a subsidiary. So all I was saying is that, again, I had a very cursory review of the investment policy, and I didn't see anything talk about investments in subsidiaries. So basically to say, like, look, if we're going to talk about investments, this being the third largest item on our balance sheet, from what I recall, I think it's in the tens of millions for sure. Just to include it in the policy itself that, we're acknowledging that this is an investment and so on and so forth. That's all I was getting at the moment is to, again, it is an investment. It's our third largest item. We should just incorporate it in the investment policy, right? In my opinion, anyhow.
That would probably be what I'm taking from everyone. That would be step one. So may we consider putting forth a resolution to ask our finance director to review our investment portfolio and consider how we could address the internal investments in our investment policy. Am I using the right words? Member Hutchings?
I would move that.
Thank you. A seconder. I have Member Thompson seconding that. And with a show of hands, all those in favor? That is passed. I think the second part, once we get past that, and we could certainly wait for another meeting, we need to do that step first. And then secondly, of course, we need to also look at that investment that we have in Niagara Power. So I don't know if it's critical to pass that policy, that direction tonight, but we could certainly try and add it to the schedule, the schedule of projects to look at. Member Howe, Councillor Howe, you have. Sorry, Mr. Poulias, we got a little bit off topic there, but you started us thinking, which is good. And so thank you for your presentation tonight. Could I have a mover and seconder to receive the presentation? That's Councillor Vardy has moved that. Councillor Howe has seconded that. And then by a show of hands, all those in favor of receiving the presentation, and that is carried. So, and just to reiterate, the resolution is to receive the delegation from CIBC Wood Gundy. Thank you very much.
Thank you for having me.
We will continue now with what used to be our two consent reports and now are on the full agenda. So we'll move to item 7.1, which is Finance Report 24-17, which deals with our forecasted debenture needs. Any questions or matters? Member Hutchings.
So we have the report in front of us. We have the director. We have the, you've done a very good job on page 4. Was that 4 or 5? Yes. Listing the ARL, the annual payment limit, to the 25%. And down below, projections will be at 9.6%. Earlier in the report, we talked about maintaining a healthy level of debt. I mean, not too many people are up at the 25, but York Region had to get special exemption for the 25%, as you know. What is a healthy level of debt? How do we, I guess what I'm missing from this is what's the comparators? What are we comparing 9.6 to? Other municipalities of our size? What are they at? Are they at 10%? Where do we compare? It's hard to say we're healthy if we're not comparing ourselves. 9.6 sounds good when you're comparing it to 25. I know most places aren't anywhere close to 25. So can we compare ourselves to others of like size, or do we? Does Grimsby? Sorry, I'll show. Does Grimsby have comparator municipalities we compare ourselves to? And can we do that when it comes to our financials as well?
Yeah, through the chair. So that information is certainly out there. We have not looked at that, but yeah, the 9.6 is based on the as yet unapproved projects. So that's based on what's in our 10-year capital plan right now. That includes a lot of growth-related projects that would be funded from DC debt. But what it does show, I guess, is that we do have the capacity to take on debt. Do we want to get anywhere near that 25% limit? No, of course not. But it does show that we have the capacity to take on debt in a strategic way where it makes sense for projects that fit the bill. But yeah, we did not include a comparison as part of the report. We could come back with a comparison if that's the will of the committee. I'm not sure where we would land if we were to say look at the other regions in Niagara, but we could certainly look at that if we wanted to follow up.
I guess what I'm saying is there's two parts to this question. Number one, I think we should try to find ourselves some general comparators that the council and this committee would see as a comparator. So I know other municipalities will compare themselves against like municipalities. They may not be in the same geographic, like size, like demographics, that sort of stuff, so you can compare yourself. Okay, so that's number one. Is just trying to for now on future reports and other things. It's nice to compare yourself to others, similar municipalities. Number two is whether you're healthy or not at 9.6 when you look at those comparators. As I said, I can go out and run a 100-meter dash in about 20 seconds or maybe 25 seconds, and I may think it's good until I compare myself against other people. Member Thompson may do it in 22 seconds. But until you compare yourself, we don't know if we're doing well or not. And I know the 25% is the provinces, but some municipalities put a cap on it. So you can't go over this, and this is what we want to be at. So I'm just saying, it's nice as it stands, 9.6. Yes, we have 14% or 15% growth. Oof, that's good. But are we doing well? We don't even know whether 9.6 is good. Lincoln maybe at 6. And we said, wow, why are they at 6 and we're at 9.6? Or Pelham or Port Colborne maybe at another level. So I'm just saying, how do we compare? Okay?
Yeah, through the chair, we do have plans to bring forward in the fall a debt kind of policy or strategy, if you want to call it that. We could include some of that information as part of that report. And yeah, the intent of that report would just be to kind of outline sort of like a baseline for the town in terms of when it makes sense and to issue debt versus when it doesn't.
Member Thompson and I are going over to the BT track after the meeting.
With his sandals and all, too. Did I see Member Scandinavo's hand up?
Yeah, just a simple question. DC debt, it relates to timing of development charges, right? Are these development charges like etched in stone? Like, are we borrowing simply for timing differences? Or are we borrowing with the anticipation of development charge receipts?
I'm going to ask Mr. Delmonico to answer that and say that, yeah, I had sent him that question as well. So just to clarify, we're talking about page 4 of the report, I believe, and where the report addresses the DC debt load, and that was my question too, is whether we were thinking that we were going to use the money in order to finance current projects and conceivably run out of DC monies. And I have to say that, once I came on council, I was surprised to learn that there are some municipalities out there who actually have negative DC balances as opposed to positive ones like ours. But I think what this report is leading us to is that at some point in time, we could use it all up and even more, and then conceivably be borrowing short term until other projects come online finally and we collect DC charges. But I will turn the floor over to you now just to clarify all of that.
Yeah, so that's right. You would use DC debt in cases where the collections lag the need for the infrastructure, and you don't have the balances in the reserve, but you have the projected growth that you will then be able to collect from future developments to pay off that debt servicing. And that's obviously something that we're going to have to keep an eye on. If it makes sense or not to issue all that debt at the same time, or if some of those projects should be staggered more, or perhaps even eliminated if the DC funding and projection isn't gonna materialize. I think a common strategy that a lot of municipalities use is that individual DC reserves can go into deficit as long as overall the DCs are forecasted to remain in a positive balance situation. You don't. And that, I think, is something that as we go through and these projects get considered, whether that makes sense for us to move forward with or not because of those circumstances.
Yeah, thanks, Tony. So I guess I'm understanding this as it is a timing difference, but it's not a timing difference with a surety. It's a timing difference in terms of projections, right? So I think, if I may say that, you noted that you want to have like a debt policy come forward like in the fall. We might want to consider what we think is, not us, but maybe what is determined as like a reasonable amount of DC debt we're willing to go into, because this sounds to me like if you build it, they will come. What if they don't come, right? And so that's the first question I had. The second question I had is, then the report's excellent. So just another comment is, on page 3 of 5 of the report, there's like showing, as you said, like obviously these aren't approved, but, potential projects totaling $51 million, right? So at what point in time, like, do we have like a cash flow estimate here, right? Because there's development charges, some of the debt's paid for by just, regular levies, what's expected to come from where, right? But again, just a thought on perhaps what we could see in the future for some of these items.
And I think I'll just refer all of us to page 4, because at the top of page 4 is a chart that does give some of the answers, I think, to your question, that showing how much would be coming from the levy, how much from development charges, and then the dotted line being our annual repayment level. But yes, anything to add to that, Mr. Delmonico?
No, that's what I was going to mention, that if you look at page 4, the bottom part of the graph there, the darker color refers to the levy the levy-funded debt, what would be funded by the taxpayers, versus the top part of the graphs, which would be the DC debt funded from collections from the development charge, collections and development community.
Member Thompson, did you have your hand up?
Yes, through you, Chair. I was just picking up on Member Scandinella there. The saying about the page 3 of 5 not being already the cash flow. So the Peach King Center, 2026, that far out. But the other ones I see is storm sewer and the intersection at Casablanca. Those were approved in 2023 under capital projects. So now they're just going to continue just rolling to 2026 and take advantage of the DCs then. Is this what I'm understanding? Just in plain, simple layman terms.
Well, I think the chart at the bottom of page 3 is the forecasted debt. It's not the actual total capital project. It's just there are projects behind that, and this chart is giving us the debt that we will be taking on to handle those projects. And that's the time of the prediction of the year that we will be issuing the debt, correct?
That's right, yeah, that's the prediction on the year. Anything beyond the Peach King still has not been approved. So.
I will add and echo Member Scandinavo's thoughts, and I'll use the phrase, that we want to make sure that those chickens are coming home to roost on those development charges. That, yeah, we don't want, it's the assurance, it's the probability of it, and we want that probability to be very, very high before we start borrowing, saying, oh, well, it's just a temporary thing, and then it'll come in next year or 3 years from now. We want to be really, really certain of those. So it sounds like this committee is, I'll say, cautious, right? And certainly at the end of this report, the conclusion and the recommendation from staff that Mr. Delmonico had already mentioned is that, there is a need for finance to develop a formal debt policy, and certainly, as he said, we could, and that will be placed onto the schedule of work to be done, hopefully adding this sometime, I will say, in Q3 or early in Q4. Would that be reasonable, Mr. Delmonico?
Yes, it would.
And at that point in time, of course, could incorporate Member Hutchings' recommendations in on how we compare to our comparable municipalities, too. Any other questions from the members? Then I will just ask a few here, too, if I may. Could you just remind me again of what the interest rate is on the debt we have for Fire Station 2? What's the rate?
Yes, it's 2.8%.
Yeah, so as we're talking about our investments, which are earning much more than that, we don't really want to cash them in to pay off, a 2% debt. So, okay, thank you very much for that. On page 3, again, down for that chart at the bottom there, I think I'm still confused about our numbers. We talk about the Peach King Center and in 2026 borrowing $8.2 million. But then there's a line after that for the Peach King Center for $3.8 million. The two together come to 12, but we talk about 11 in the report. Could you just clarify what the second item is and how that comes about?
Sure, yeah, the 11.4 million that you'll see in the Peach King report, that's the original amount of levy debt that we were projecting for the Peach King Center. That's now down to the 8.215. So that's the levy debt that we're projecting for the Peach King. And the difference there is because over the past few years, we've put away some dollars in reserves in the Peach King Reserve in building up an anticipated amount to be for the debt servicing eventually. So that 11.4 in levy debt is now down to 8.2. The 3.89 is would be DC funded debt. So that's when you look at the Peach King report, it's included in the development charge number. Yeah.
Thank you for clarifying that. I was, and the 1.6 million that we are considering setting aside from the surplus this year is already incorporated into these numbers then. That's how we also get from 11.4 down to 8.2? Okay, thank you. Any other questions on that report? Then, we had someone move it?
Member Hutchings.
Oh, Member Hutchings moved the acceptance of this report. If we could have a seconder to approve the report, Finance 24-17 on the forecasted debt needs. Councillor Howe has seconded that. And with a show of hands, all those in favor of the resolution, thank you, that is passed. Then we will move on to the second report, which is Finance Report 24-18. And did anyone have any, I believe I've got that right? That's the next item on our agenda. Any questions or comments about that particular report? Councillor Howe.
The reasons I had for lifting it was just answered in the prior discussions in respect to financing and numbers, so.
Any other questions from any of the members? So it's the Peach King Center report now, the 4-page report we're dealing with. If I may ask then, so I mean, within here, we have two estimates, Aquacon, and I'm talking about page 2, Aquacon Construction as our construction manager, and then Turner and Townsend. And obviously, we like Aquacon's numbers better because their predictions are much more in line, and the second party less so. But could you just sort of expand on that for us? Because later in the report, you do say that you find their projections, I guess, to be more accurate. And why is that? And
Yeah, you'll notice, the one estimate shows about 598,000 of an overage versus the 1.6 from Turner and Townsend. And that's, I guess, related to different methodologies that they probably use to come up with their estimates. I believe that the area where it's causing the difference is related to the mechanical portion of work, and Turner and Townsend is probably being a little more conservative in their estimates in terms of where we could see the tenders come in, which is causing that difference. Aquacon, through the previous tenders, came in closer to what Aquacon estimates were projecting, so we hope that continues. But ultimately, it's going to, the important number is going to be where the actual numbers come in, and that'll determine if we're remaining within our budget.
And then the report on page 4 talks about, and really almost right before the chart, there's a paragraph there, says results from tender package 3 are expected by the end of June. And I guess tomorrow technically is our last working day in June. So do we have an update on that, or are we still waiting?
Yeah, not yet. We know that the submissions have closed. The results are in the process of being reviewed. So we'll have a better update at our next meeting. So I'm sure you can appreciate that the review process still needs to be happening for completeness of the bids.
Thank you. Any other questions on the Peach King Center report? Then likewise, if I could have a mover and seconder, and I'll just read the resolution. That report, Finance 24-18, the memo on the Peach King Center expansion cost update that's dated June 27th, 2024, be received as information. Councillor Howe has moved that. A seconder for that, please. Member Thompson has seconded that. And all those in favor of that resolution by a show of hands, please. And that is passed. Then moving on to item 8.1 on our agenda, which is Finance Report 24-15 on the West Lincoln Memorial Hospital debt issuance. Yes, Member Scantinabo.
I'd like to abstain from this report if possible. Like I work at Hamilton Health Sciences, and I just want to abstain for any potential conflict or perceived or actual. So I'll just I'll remove myself from this discussion.
Thank you. That will be noted in the minutes. Mr. Delmonico, if you'd like to speak to this report.
Sure, thank you. So the purpose of this report is to give Niagara Region authorization to issue debt on our behalf related to the hospital. Our contribution has been previously confirmed at $9.3 million, and we've increasingly been setting aside funds for eventual debenture issuance. The amount to be debt funded is $7,369,000, and this represents the amount owing of $9.3 million, less the amounts that we've saved in the hospital reserve to date. So we now have $538,000 in annual contributions approved as part of our operating budget to support these debt payments. And the actual amount required will depend on interest rates and prevailing market rates at the time of debt issuance by the region. So we may need to increase the annual contribution from operating if needed as part of the budget process. As I mentioned, we have that $538,000 set aside. We're estimating that amount can support a 4% debt issuance. If that were to be 5%, for example, we'd need $49,000 more to support the debt payment. So just to give you an idea. Current posted rates on the Infrastructure Ontario's website show lending rates of 4.5%, just as comparison. So again, the purpose of the report is to provide Niagara Region with authority to issue debt on our behalf for the hospital, and our share of the contribution to the hospital project is due this January.
Thank you. That was actually going to be one of my questions. As you were speaking, the exact payment date to Hamilton Health Sciences will be January. So the expected date we would receive our cash from the region issuing the debenture is obviously going to be earlier than that. Approximately when do you think? Like, are we talking September, October?
Don't have an actual date on that, but yeah, it would be sometime in the fall in advance of that, the payment being necessary.
Any questions from members? Councillor Howe.
Through you, Chair, and probably for the director. In the resolution number 2, the recommendation, approve the grant funding to the Hamilton Health Sciences Corporation. I was under the impression that the check would actually be flowing through the foundation, the West Lincoln Memorial Hospital Foundation, as opposed to directly into Hamilton, that there was a perception of ownership or continuity, or that in fact that it was going to end up, they've got their own office, but right across in that big new building, that all those funds were going to go into there. Am I completely wrong, or did I understand incorrectly, or can we do it in through the foundation?
Yeah, through the chair, no, you're right. That was the original plan, I believe, was to provide it to the foundation. I think in looking at this closer, Niagara Regions advised us that payment can't be made to the foundation. It needs to be made directly to Health Sciences, and the foundation has been made aware and are on board with that. Member
Thompson.
Yes, through you, Chair. Just asking yourself or any of the experts on this panel here. Page 3 of 4 of the report, you're talking $538,000, 4%, and then compared to the 5%. Should we be looking at requesting the $49,000 this year and giving the 5% in your expertise there, Director, and anybody else on this committee?
Sorry, I missed that. Could you repeat the question? I don't think that's needed right now. I think that'll depend on what our actual rates are when we go to market. So I think it's fine to leave for the budget process if an increase is needed.
And actually, we are in 2024, so there was a budget passed for 2024, so we're not intending to amend the budget. I think what the report was really came down to, my understanding at least of the conclusion, was that if the rate turns out to be 4.5% or 5%, as is used in your example, and there is a higher amount needed going forward, that perhaps even in 2025, we may make up the difference and then normalize after that, to use the word around the table today. Would you like just to comment on that, Mr. Delmonico?
Yeah, no, that's absolutely correct. Yeah, we would identify what the gap is there and bring it forward as part of the budget process, and then we'd have our set amounts for the rest, the next 20 years.
In fact, that is something to note, that we're talking about a 20-year debenture in this case. I think some of our neighboring municipalities who are also going out to finance this debt, we're looking at longer time periods for their debentures. Are you familiar with what's happening with our two partners around the table as to what they're doing in terms of what they're borrowing or their terms or anything like that?
Yeah, I'm not sure exactly of the terms, but I do know that Lincoln and West Lincoln are going to be debt funding the majority of their shares as well. I believe Lincoln's in the 8 million range and West Lincoln's 4.5.
Councillor Vardy had her hand up, so I'll recognize her next, and then Member Hutchings.
Thank you. My question is really around Fire Station 2.
That's not this report yet, though, is it?
Yeah, it's on there.
We're talking, sorry, we're talking
on the
about
wrong report?
Yeah, we're talking the West Lincoln
sorry.
Memorial Hospital one.
Forgive
So
me.
we'll hold that question, though. Any others before I move on to Member Hutchings? We'll give you time to think, and I'll recognize Member Hutchings next.
I just want to say, you can relax. I'm not going to ask you a question or direct you to do anything. Just relax. I'm going to give a political speech here, so it's not a finance. I just want to say how proud I am of sitting here at this table right now. As a person, Councillor Howe sat on the hospital board. Councillor Davily was the board chair before me at the West Lincoln Hospital. I was the board chair from 1999 to 2001, when we went through the whole hospital restructuring and had all the people at the hospital, at the downtown, and we had all the announcements. And we started a process after we were all done, and we entered a management services contract with the Hamilton Health Sciences. And we hired we lost our executive director, who was awesome, Gord Gibson, and hired a new young executive director named David Bird. And we worked and eventually merged over the years with Hamilton Health Sciences. And we've created plans to create a new hospital and build a new hospital. And here we are 27 years later, almost 25 maybe, years later, and we're getting a new hospital. So I'm very proud that three of us here sitting on this were on the hospital board when all those were fighting to keep our hospital and keep our local governance. I still got my T-shirt. I'll wear it sometime here. I still do. It fits still, just to let you know. I'll wear it when Billy and I go over and run the 100 meter. Still fits. Anyway, but in all seriousness, I'm very proud to be sitting here at this other end, approving a finance report that's going to prove money to go towards this hospital and a great need for our community. So that's my political speech. You can relax, Director, but I am seriously proud that we have one little part of it 25 years ago and see the end of it. So thank you.
It is special to finally come around to this point, yes. Any other questions on this particular report? We need a mover and a seconder, and let me just reread that resolution again. So the resolution says it's resolved that Finance Report 24-15, the West Lincoln Memorial Hospital, and yes, we are still calling it that, financial grant funding dated June 27th, 24, be received as information, and that council hereby approve the grant funding to the Hamilton Health Sciences Corporation up to the amount of $9,300,926 towards the construction of the West Lincoln Memorial Hospital, which in the opinion of council is in the interest of the town of Grimsby to make such a grant, and that council acknowledges Section 106 of the Municipal Act 2001, which prohibits financial assistance to commercial enterprises and confirms that the grant funds will be used only for the non-commercial capital components of the West Lincoln Memorial Hospital project, and that council authorizes the region of Niagara to proceed with a debenture issuance on behalf of the town of Grimsby in the amount of $7,369,926 for a term of years not exceeding 20 years, and that council confirms that the treasurer has updated the calculation of the town's annual repayment limit, ensuring that the town is within the provincial limit. And so if I could have a mover and a seconder. Councillor Howe is moving that.
I want to second that.
Member Hutchings is seconding that, and all those in favor by a show of hands, please. And that is carried. Okay, I do confess to being surprised, too, at how long that resolution was. We will now move on to item 8.2, Finance Report 24-16, dealing with our fire aerial truck replacement. And tonight we welcome as a guest Fire Chief Hudson, who's here with us. So I'm thinking maybe if you'd like to come to the podium and just sort of walk us through that. I realize it's also a report from Mr. Delmonico, but perhaps you could just walk us through the purchase of the fire truck and why you need our approval this evening. And you're welcome to do it as a tag team.
Thank you, Chair. Perhaps if I could start. So the purpose of this report is to get approval for the remaining necessary funds for the purchase of this fire truck. The procurement was initiated in 2022 for a stock vehicle, a large, long aerial fire truck. And after speaking with the supplier, it was discovered that the change orders were required to the stock model. And staff were under the impression that sufficient funds were already approved, even with the change orders that were necessary, so they proceeded with that order. However, only 1.6 million was actually approved and 1.7 million was needed. So we're asking today for just under 100,000, 99,561 to be added to that project budget. The truck has actually already been delivered. It's at Fire Station 2 now, and the vendor is aware that we're in the process of securing the remaining funds.
Chief Hudson, would you like to add any thoughts to that?
Thank you, through you, Chair. Yes, so as Director Delmonico said, the truck is here. It's at the end of the day, 1.8 was budgeted. We are significantly under that, and I can say, in speaking with the vendors, an identical truck purchased today would be well over 2.5 million. So I think at the end of the day, this is actually a good news story. I've been asked, what were some of the drivers that precipitated some of the change orders and why did it cost more? And really, when you buy a stock truck like we did, and we did get a good deal on a stock unit, which is basically a base model vehicle. And there were a number of items that we did have to add to bring up to Canadian standards because it was manufactured in the United States. And there was a number of operational and health and safety items that we did add as well. And I won't go through the whole list, but essentially we had to Canadianize the threads that we connect hoses to bring it up to Ontario standards. We had to bring the gauges up to metric gauges to comply with Canadian standards. We had probably the lion's share of the cost was associated with adding a breathing air system to allow the firefighters working at the top of the ladder in the actual basket to plug in to their self-contained breathing apparatus to be able to work in smoky atmospheres for extended periods of time. The alternative, if we didn't have that, the firefighters would have to climb up and down the ladder every 10 to 20 minutes to refill their cylinders, and it's just not operationally feasible, or that's from health and safety concerns associated with that. And probably the other biggest biggest ticket item was the upgrade of the engine to about 100 additional horsepower to be able to climb the escarpment. And when we actually finalized the specifications for this truck, we did have the town mechanic in attendance, and it was very highly recommended that we have a truck that's got enough power to make it up the hill. Otherwise, it's quite embarrassing to respond to calls we can't make it to with the truck. So I can assure you that we did try it. We did do a road test, and it does make it up the escarpment very handily. And I also wanted to point out the fact that not only did the change orders reflect some additional costs, but we also realized a savings in about $12,000 in items that we didn't require. Probably one of the most surprising is the cost of paper service manuals is very, very expensive. And in the original specification, it called for multiple copies of, a vast array of service manuals and to the tune of $1,000 for a set of multiple sets of engine service manuals and transmission service manuals. So we sold it for one set of paper and the electronic version, and the town mechanic was quite happy with that, and the others would have just sat on the shelf for the next 20 years anyway. So, and a number of other items that we felt were redundant, and we were able to cut out of the specifications, but at the end of the day, we ended up with a very functional, very high quality item that'll service the town of Grimsby for the next 20 years. So.
Thank you. Any questions from the committee members? I'm not seeing any, which is good news. So thank you for being patient and waiting till this item came up on the agenda. Then I will read the resolution. Yes?
Well, yeah.
Did you have a question or a thought? Go ahead.
I have a fire-related question. So it's not specifically related to the aerial truck, though, but
I'm going to say dealing with operations or something like that, which is not really our mandate tonight.
I'll tell you what the question is, and you can
Okay.
tell me to forget it or whatever. Fire Station 2, I think when it was foreseen, there was a notion that there would be some revenue generation from it. So I'd like to see a gap analysis between what we thought it was going to bring in and what it actually brought in, because without data to say that I'm wrong, I'm thinking it's really underutilized, and we should look at ways that we can not repurpose it, but multi-purpose it. So I wonder if that's a report that Finance and Fire could put together. Okay, thank you.
And I'm thinking that it is June, which means, just to go ahead, our next meeting will be in August. Will our 6-month, year-to-date report be ready for August, where we analyze, budget to actual comparisons and things like that? Or do you think that might be September when we see that one? Because I'm thinking that's a good jumping off point to actually have this analysis as part of that. Mr. Delmonico?
I believe that is for September, and I think that would be a good time to kind of look at that. Thank you. Yeah, September is when it's on the work plan.
Would that help? Yes? Okay. Then the actual resolution that I will read first and then ask for a mover and a seconder is resolved that report Finance 24-16, the Fire Department aerial truck replacement budget amendment dated June 27, 2024, be received, and that Council approves additional funding of $99,561 for the replacement of the Fire Department aerial truck for a total project cost of $1,747,939 to be funded from the Equipment Replacement Reserve for Fire to support the commitment to purchase one new 2023 Spartan 100-foot aerial platform truck. A mover, please. Member Thompson has a soft spot there for fire, so he will be our mover. A seconder, please. Member Howe has, and all those in favor by a show of hands, please. And that is passed. Thank you, Chief Hudson, for coming tonight. Next up on our agenda, it would typically be agenda item number 9, which is correspondence, and we have done tonight. And then we will move to item 10.1, which is the water main rehabilitation at Oliver Lake in Ontario with a verbal update, which I assume is coming from Mr. Delmonico. Thank you.
Yeah, thank you. This is just for information of the committee. There's going to be a report that's going to council for a sole source vendor recommendation and approval. Niagara Region has hired a contractor via their regular competitive procurement process to do some design consultant work on a sanitary force main, region force main on Lake Street, which happens to be adjacent to work that we're planning and need to do on the related water mains. So the sole source will be going forward because we feel it makes sense at this time to have that same consultant perform the work at the same time while they're there. It'll provide efficiencies in time and cost, such as field surveys and preparation of drawings. So this is work that we here at the town have already budgeted for, and we're planning on completing the design this year anyway, with the construction happening next year. So just wanted to give a verbal update.
Thank you. Any questions on that? Then we will move on to our next item, which is the new item we added to the agenda, 10.2, and to discuss the timing on the release of our agenda and our reports. And Member Scandinavo, you raised it. Would you like to speak to it first?
Yeah, sure. Thanks, Chair. I'm just curious maybe how we could refer this matter back to staff to examine perhaps an earlier release of the agenda and the reports. It's my understanding that the bylaw reads 48 hours, but I guess in order to give some thorough consideration and deep thought to what's presented to us, I was wondering if we could perhaps consider maybe instead of 2 days before, maybe 4 days before, receiving it on Friday end of day would not only would it give you 4 days, but it would also allow the weekend to, again, really review the reports, determine if you have any questions, consult some of those questions in advance of the meeting. So just thought I'd put that on the table and see what everyone else's thoughts were. Again, understanding, needs to be considered, with the staff and if that can be operationalized.
Any other thoughts from committee members? Councillor Howe.
I can certainly emphasize with the member, when it comes in 2 days before and you're in the middle of your work week, it doesn't leave a whole lot of time to try to ingest the important information. Now, as council and member, we get most of ours by the Thursday or the Friday, and we've got the weekend. But in this case, especially with the finance coming on the Thursday, I can certainly understand the members' concern to try to get them, because when you get back to a full schedule, there is more than enough to try to impart from the reports and to do it right and do the job right. And I think it probably can be done, but I would like to see staff come back with some, what they can be done.
Our clerk has asked to speak on this, so I will give the floor to her.
Through you, Madam Chair, that's no problem. We can refer it back to staff. I do have a motion here drafted, just to resolve that the timing of agenda publication be referred back to staff for further consideration. Our senior management team would have to review that, but if that's something the committee would like to do, then we could put that forward.
Any other committee members who'd like to speak to this?
I think it's a great idea.
Go ahead, Member Scandinavo, you have the floor again.
Sorry, maybe I'm being nitpicky here, but in the motion, could we specifically state, a recommendation that we're looking prior to the weekend, or do we just want to say refer back to staff? Because last thing I'd hate to see is, it going from Tuesday to Monday, which, yeah, it does help, but I am really looking for it to come the week before. Again, just my opinion, but I'll leave that open-ended for you guys to discuss.
Comments from anyone on that? Councillor Howe?
And suppose we make a more of a generic conversation as to the approach for the information, the agendas coming to each of the standing committees, you know, especially. Obviously, council, we got a certain time window on that, but make it a little bit more generic and not just real specific to this committee, but as an overall, and just, that'd be my thought.
Any other comments from committee members? I think what's unique about finance is that we're probably one of the few committees that actually meets on a Thursday. Many of them meet on Mondays or Tuesdays, and so their agenda comes out 48 hours, which means it's really coming out on Friday at the latest, and as Councillor Howe said, sometimes on Thursday. But because we meet on a Thursday, it means we don't benefit from Saturday and Sundays. And so, you know, if Saturday and Sunday were not holidays, you know, and we had to meet this 48-hour rule for council or public works or anything like that, it would be coming out, you know, almost on a Saturday in order to meet the 48-hour rule. But because finance is on a Thursday and we have followed that rule so religiously, it is making it very hard, especially because we do have members on this committee who work full-time. And so it only leaves, you know, 2 evenings for them, whereas when matters are released on a Friday, it opens up the weekend even for everybody to be able to do it. And so I don't know if there are other committees in this same sort of predicament, but certainly we have felt it on finance and would like to support that idea that, you know, an earlier release would be much more helpful. And it's especially acute, I guess, for finance because we always meet late in the week and then it just makes it very tight. Our clerk had a resolution here, though, and we have a suggestion from Councillor Howe. Would you like just to read that resolution for us again?
So the resolution says, resolved that the timing of the agenda publication be referred back to staff for further consideration. Now, I can include any more specific, like the week before. Like Councillor Howard mentioned, some committees meet earlier, so they already get that weekend. So it would be sort of specific to the Finance Committee. So definitely hear you. We can take that back and report back on that.
To the committee members, would you like to add something to it to consider release of the agenda and reports by the end of day Friday prior to the meeting? Would that help? Member Hutchings?
Yes.
You could read it again?
Yeah, so resolved that the timing of the agenda publication be referred back to staff for further consideration and that the committee recommend the agenda be published by end of day, Friday before the meeting.
That sounds like everybody is nodding in agreement, so, excuse me, if I could have someone move that. Yes?
Chair, the only other one that I could think about, and the clerk can probably straighten me out, planning being Wednesday night. When do they get Monday? And some of their agendas are just hideous for length and detail. Would it, in fairness to them?
Go ahead.
The resolution isn't specific here. I'm not saying anything in the resolution that's specific to that the Finance Committee's agenda. We're just going to look at it as a whole and see what we can do about pushing back some of the agenda timing for that.
Any other comments from committee members? Member Hutchings?
So if this is general, that will a follow-up come back to finance, or are we going back to council?
Through you, Chair, I would assume Finance Committee since it came from Finance Committee, but I would have to double check on that.
Is it somewhere in our rules of procedure that, or in some internal document that specifies the 48 hours? And that's why I'm thinking maybe wherever that document is that says it'll be released at least 48 hours, that document would need to be amended once it's, if the recommendation is supported by staff.
Okay. Through you, Chair, it's within the town's procedural bylaw, And we're going to be coming back shortly to council with the procedural bylaw amendments with the housekeeping amendments that were approved earlier in May. So the procedural bylaw will be coming back anyway, so we can include this as part of that. I think we're forecasting the August or September meeting for council to bring that back.
So timing is good. Okay, so I still need someone to move, and that's Councillor Howe, and second it, Member Scandinavo. All those in favor by a show of hands, please. That is carried. Thank you. I believe that concludes all the items on the agenda. Our next meeting is August 22nd, 2024 at 6 p.m. Member Thompson. Other business, yes, for sure, go ahead.
Other business, if you don't mind, through you, chairs, just to the director. Today's newspaper came out with Lincoln coming out with a survey for 2025 tax survey for their public. I was just wondering if we're looking already in advance. I know you're new to this, and Grimsby, trust me, I despise seeing budgets being approved in May and June. And I know we're getting better, but when I see that come out, it's a really good thing. And I'm hoping we're proactive and starting to move that way in the future. But it was nice to see today in our local paper, they go on a QR code and they get right into a survey.
Yeah, we are planning on issuing a survey in August related to the budget. So, and we're hoping we can move the budget timelines up by a month this year. That's what we're targeting.
Thank you. Any other questions or matters to raise under other business? Then without that, again, to repeat, our next meeting is August 22nd, not July. And I will call adjournment of this meeting. Thank you.